Um, First of all, thanks everybody for coming. As usual, normally I say at the start of these, I'm John Haig, I'm the co-director of the Mosava Rahmani Center for Business and Government with Larry Summers. And I usually say, I'm glad we had food because we seem to be able to attract students when we have food. But the difference today also is that we have such a terrific panel to talk about this important issue, the future of the dollar. And I'll go through real quickly. Carmen Reinhart is the Minos Zombanakis Professor of the International Financial System here at the Harvard Kennedy School. She has a terrific background for this Kennedy School in particular, given not only is she a renowned academic, she wrote a terrific book and multiple books, but with Ken Rogoff on This Time is Different, 8 Centuries of Financial Folly. But she also was the senior vice president and chief economist at the World Bank. She was the chief economist uh, actually with a private sector background a bit. She was the chief economist at the investment bank Bear Stearns in the 1980s. Um, I threw the date in specifically because I knew the timing was reasonably important there. Um, uh, and she just has a terrific reputation here at the school as well. We also have with us Jason Furman, and I probably shouldn't have to look at this. I've said this enough, but he's the Aetna Professor of Practice of Economic Policy, and he has a joint appointment here at the Kennedy School in the Department of Economics. I don't know how many of you know that undergraduates take the largest single course at the Kennedy School is Ec 10.
College.
At the college. At the college. So he teaches Ec 10. He co-teaches Principles of Economics. That is the largest, Ec 10, that is the largest course. He served 8 years as the top economic advisors for President Obama. He was the 28th chairman of the Council of Economic Advisors from 2013 to 2017, and was a member of the cabinet. He also worked in the Clinton administration and has obviously
Never worked at Bear Stearns.
never worked at Bear Stearns, but certainly is not shy about expressing his opinion in the New York Times or the Wall Street Journal. I encourage you to go find what he's written on a regular basis. And then the last person I want to mention is Edo Campanella, who is going to be our moderator today. He is a senior economist, global economist at UniCredit Bank, and also a senior research fellow here at the Kennedy School. And he writes globally syndicated columns for Project Syndicate and other foreign policy, foreign affairs, and others. And he's a David Rockefeller Fellow of the Trilateral Commission. With that, I will hand it over to our esteemed panel, and I'm looking forward to learning a lot.
So thanks a lot, John, for the introduction. It's an honor and pleasure to moderate this panel with Carmen and Jason. It's one of those panels where I think we will not disagree on many things, but we will try to make it as lively as possible. Since not all of you might be following financial markets on a regular basis, on a daily basis, I think it might be useful to give to kick off the discussion by giving some context. The dollar is now down 10% since the beginning of the year across the board in trade-weighted terms against the main currencies. It's the worst depreciation of the dollar in a few months since 1973. So my first question to Jason is, what are the factors behind this fall? Are they structural? Are they just transitory?
So, is my thing on? I hate to start this panel on the wrong foot, but my answer to your question is I don't know. In the college class I just taught, the entire class was on the limits of economic knowledge. The importance of acknowledging the things you don't know. Ben Bernanke once gave a graduation address at Princeton, a great economist, where he said economists are not very good about telling you what will happen, but afterwards they're very good at explaining why it was inevitable that thing happened. So when we talk about financial markets this year in 102, which I teach here at the Kennedy School in the spring, and Carmen used to teach that for the most part, when you increase tariffs, the exchange rate appreciates. You're buying less foreign stuff, so you're not buying as much of the foreign currency, so you're not pushing it up as much. You're pushing the foreign one down, that pushes your own one up. That's a standard staple of models. And the tariffs we have right now are just much, much higher than anyone expected. We went from an average tariff rate of 3% last year to what is now an average tariff rate of 18%. And most people were thinking maybe it would go from 3 to 8 or something, not 3 to 18. Now, there is then a second qualification to what I just said, which is in some circumstances, if you do something that makes everyone so worried about your country that they don't want to have money in your country, that can make your exchange rate go down instead of up through things like confidence. And once you have confidence and risk in a model, you can sort of get anything for any given variable. But I say for any given variable because there's a second variable here. So I would have said probably the dollar will get stronger. But if it doesn't, it's because people are panicked about the United States. And here's how you can tell. The dollar will go down and interest rates will go up, because who wants to lend money to a country that they're terrified about and think is really risky? Well, that's the second problem, which is that second thing hasn't happened. So the United States being more risky does fit the risk of tariffs. It does fit the exchange rate. It doesn't fit interest rates. Faced with this quandary, my tentative answer to your question, Edoardo, is that if things are really scrambled in weird ways, that things depart from the fundamentals for all sorts of reasons in the short run, that often I sort of believe the fundamentals is a better prediction in the long run. And so I think maybe there'll be some strength in the dollar, a little bit the way our models predict, and some upward movement in long-term interest rates, again, like that other set of models predict. And so all of this is on the transitory side, but that is not something I would go out and suggest you day trade based on.
So
and my future answers will be shorter than that.
So, Carmen, I can't resist the temptation to ask you whether you know what's going on.
With regards to what?
To
With
the fall,
regards to tariffs, if somebody knows what's actually happening with tariffs, have the kindness to explain it to me. What is going on? I think Jason's second part of the answer is the one that I embrace the most. I think lack of confidence, uncertainty, uncertainty not just about the near term, but about the medium term. I increasingly get question after question. Is the demise of the dollar as a reserve currency around the corner? My immediate response to that question is not compute short-run weakness developments. Apart from, you mentioned the weakness of the dollar in the 70s. It wasn't weakness. It was an outright crash against the Deutsche mark, over 50% crash. And yet the dollar persevered as a reserve currency. My response is, it takes a model to beat a model, meaning we need an alternative. That would be because I had
At least we know that they're paying attention.
You need an alternative. I don't know whether the weakness will catapult into something bigger or whether it will be a temporary flux. I think Jason is wise to lay out that, in effect, currency movements are one of the things that are least predictable. My co-author Ken Rogoff wrote about this many, many years ago. And the point of confusing the short-run demise with the long-run potential for a decline of the use of the dollar as a reserve currency is often linked to issues of the weaponization of the dollar. It's linked to the tariffs, not in the way that a model would explain it, but in a way that leads other countries also to look more inward or look elsewhere. And elsewhere includes gold. So if anyone that has been following the dollar might have also looked at what's been happening with gold prices are setting new records. And historically, gold prices have been very much a metric, not just of classic expectations of future inflation, right? Because we've actually surpassed the levels of the gold prices in the late 70s, which was inflation time, but also of uncertainty. And so, that's also a long-winded answer. I'll be brief.
But can I just pick up on that, just to be conversational about this? I think what Carmen said at the medium term was really important, and also institutions. So you look at what happened a couple of years ago when, for like a minute or two, Liz Truss was Prime Minister of the United Kingdom, and you saw the largest movement against their debt markets in modern times. You saw a dramatic change in the pound exchange rate. And why did it happen? Partly, she proposed a budget that I think raised the deficit by 1.5% of GDP, which is a bad thing to do when you already have a deficit. But a lot of countries have done that. The United States, for example, did it a few months ago. She did it at the same time that she was talking about taking independence away from the Bank of England, ignored the nonpartisan officials in Treasury who assess these types of things, and it gave rise to a concern that this was part of an institutional change. And so it wasn't that you could run a mathematical model and I could translate 1.5% of GDP into percentage points on interest rates or an exchange rate. You had to look at the full institutional complex. And that's what gave rise to it. So now let's get back to the United States in the medium term. I am personally nervous about the independence of the Federal Reserve under Donald Trump. I'm also nervous about the future of the Fed, regardless of who's president next. Let's say he appoints a partisan hack to be the chair. The next Democrat, rather than doing what the last three Democrats did and reappoint the Republican picked by their predecessor, Alan Greenspan, Ben Bernanke, and Jay Powell, they might say, oh, Trump had a hack. We're not going to make the same mistake that Obama made. We're going to find our own hack and put him in there. And all of a sudden, the Fed, instead of this sort of respected independent institution, becomes like a partisan football. The tariffs, a lot of Democrats are against them now. 3 years from now, if they're still in place, and who knows the courts, who knows Donald Trump, I share Carmen's confusion, they'll be bringing in a lot of revenue. People will be used to them. There'll be all sorts of vested interests that get hurt if you tried to take the tariffs away. I'll be advocating getting rid of them, but they might have some political staying power. So I think, and then just more broadly, the expansion of executive power we've seen the last few months. It's possible a Democrat would come in and say that was too excessive. I want to return things. It's possible they'll be like, heck yeah, I love everything Donald Trump did. I just want to do the Democratic version of it. And so a lot of this medium-term stuff, I think, is about changes underway now that reverberate, regardless of where we are next politically, or risk reverberating.
So, in talk, of course.
Look, I think what Jason just said highlights the degree of uncertainty and how many threats we face uncertainty. However, I'd like to highlight some things that we know for certain. The U.S. Treasury, investors, central banks do not buy dollars, they buy dollar assets. And the most liquid asset is Treasury securities. You don't construct a deep and liquid market overnight. It's something that takes time. That's why I talked about alternatives. Now, this doesn't mean that the pendulum hasn't swung away from the dollar. It has. But there are limits to that, given the lack of alternatives.
Yeah, we will discuss that in a moment. Talking about the Fed, because I think this is important. It's not only about the chair. It's the fact that Donald Trump is basically trying to take over the entire FOMC. basically by taking control of the board of the Fed and trying to manipulate the nomination of regional president in February. Do you think that's a serious challenge that's one of the dimension of the challenge for the independence of the Fed? Or
Yeah. So the Fed was set up by law to protect its independence by people get 14-year staggered terms. So every 2 years, one of the 7 governors' terms ends. That means in one presidential term, you just get 2 appointments guaranteed. Some people leave earlier. Maybe they get fired. We will see what the courts say. In addition, there are 12 regional presidents. They're all picked in strange ways by their boards that, frankly, I don't totally love. But it's not picked by the president and the Senate. And 5 of them at any given time get to vote. There's this procedure that Edoardo just referred to that almost no one knew about 6 months ago, and now everyone is hyper-focused on, at least everyone being defined quite narrowly as like the people on this side of the table, which is that every 5 years, the 7 people on the Board of Governors needs to approve all 12 of these regional bank presidents. And so it could be that if there were 4 people out of the 7 on a committee that totals 19, the 12 reserve banks around the country and the 7 in Washington. So if just 4 out of those 19 people went a bit rogue, they could basically get rid of 12 of the 19 people and then effectively replace them with their own people. I am pretty reassured about where we are right now on that. 2 of those 7 people just voted with Jay Powell to only cut interest rates by 25 basis points, which is much less. I'm sorry, lots of people voted with him, but 2 people that President Trump had appointed voted with Jay Powell for a much smaller interest rate cut than he wanted. Firing Reserve Bank presidents would be a larger thing. But what I am worried is if you erode the for cause, you're not allowed to fire someone without cause. If you erode that and the cause is like, you saw them jaywalking, now you can fire them, then you can get 4. Then 4 out of the 7 can fire any of the 12 for cause. And so if the standard is lowered, you do step 1, you do step 2, and then your central bank independence is gone. I think we have courts protecting us, markets, maybe the Senate, but there are scary scenarios there. I think there's still more like tail risks, but larger tail risks than we faced before. Big tail, I agree with that.
Carmen, still talking about the mandate of the Federal Reserve, many people, particularly in the Trump administration, believe that the Fed went beyond its mandate, especially when it comes to issues like inclusion, green monetary policies, and stuff like that. Do you agree? Do you think it went too far? Or?
And frankly, I think that's third order. I think the critical issue is U.S. debt servicing costs have increased very significantly. As a matter of fact, if you look at all the advanced economies at the moment, according to the World Economic Outlook, the IMF, the U.S. has the highest debt servicing costs and poised to go higher, given the fact that interest rates have softened but not have fully reverted, and the stock of debt keeps getting bigger at a very rapid clip. So that's the real crux of it. We want cheap rates. Fiscal dominance is extremely dangerous. We, in its most virulent form, you see it during a war, right? The central bank becomes the agent of the government and finances whatever. In peacetime, it's managed to deliver countless inflation episodes across the globe. So I think, the prospect of loss of central bank and loss of Fed independence is very scary. I think some of the uncertainties that we are talking about also regarding the dollar, regarding the volatility of fixed income markets have to do with also concerns that, is the U.S. reverting on that scale? Because the Fed was not always independent. I mean, there's de jure independence and there is de facto independence. De facto independence was certainly not what we saw during the 1970s. It took the arrival of Paul Volcker, who was the push behind the big disinflation. Remember, the U.S. inflation rate, hovered around 13–14% in the late 70s before it was brought down. So that is yet another concern with the possible loss of central bank independence. You can be sure we're not going to lose it legally. The question is whether de facto, as Jason was discussing, you stack the board, honestly, I think the mandate issues that you asked about are completely secondary to the central issue is I want low interest rates.
Let's just say two things super quickly about that. One, and it's just an agreement. If I went to my doctor for my annual physical and they said, "Great news, you're probably not going to die. It's only a 10% chance that you will in the next month." I don't think I'd feel super comforted by the fact that probably I would live. So the Fed is almost as important to me as my life, and the chances are maybe maybe 10% is the right way to think about it. The second thing I would say is I think in some ways I would have said the Fed's expanded mandate was sort of second and a half order. I would have said second until Carmen said third, and she usually has a lot of wisdom to her, so I revised from second to second and a half order. Here's the problem. They started talking a lot more about a lot of issues like climate change, but they got the worst of all worlds. They didn't actually act on them or do anything. So they sort of convinced the people that thought the mandate was too broad that they were doing all this other stuff without actually doing all this other stuff. And the argument is that that distracted them from their main job. Just to ask you all a question, I have been plenty critical of all sorts of moves the Fed has made. In January 2012, they established formally that they were targeting an inflation rate of 2%. Anyone want to guess what the average inflation rate has been from January 2012 to the present? Just shout out three numbers. I won't call on you. 2.2. So, it's not perfect. Should have been 2.000, but like compared to everyone else in the federal government and how they manage economic policy and handle their own business, being 0.2% off on average is it's a lot better track record than you're getting from any president or Congress.
And it's also important to emphasize that even if Trump manages to take control de facto of the central bank, he might not get what he wants in terms of interest rates, in the sense that he might manage to get a lower interest rate short term, but if the market loses confidence in the US, interest rate, long-term interest rate will go up. You will have a steepening of the yield curve. So it's a difficult balance what the next Fed will have to strike. And that's why maybe, I don't know if you want to comment on this, Miran, who is now member of the Fed, he's still on leave actually, as chair of the Council of Economic Advisors, recently said that the Fed should introduce a third mandate focused precisely on managing the long end of the curve. Do you think that's possibility, a serious possibility?
Well, we tried it in World War II, and hence, please remember my earlier remarks about fiscal dominance during wars. Japan has had yield curve control for years. It's very clear to me that the BOJ has enabled the government to maintain the levels of debt that it has. And if you look at Japan's debt servicing costs, notwithstanding the very high levels of debt, they're quite low. And part of that is, I would note that the balance sheet of the BOJ, a conservative number, because I'm not including equity and everything else, but just holdings of JGBs, government debt, is about 100% of GDP, which surpasses any war record it's when, I don't take the term unprecedented lightly, because usually unprecedented means I don't know any history, but this, I do think this one is unprecedented.
So,
And at least 700 years of history.
At least.
so, so basically, we just answered the big question that there is no alternative to the dollar at the moment as a reserve currency. But trying to think about the possible alternative and how things can evolve over time, what's your view about the euro?
So a number of years ago, Larry Summers famously said that the dollar is going to continue to be the reserve currency because Europe is a museum, Japan is a nursing home, and China is a prison. And ever since then, European productivity growth has been even worse, and the paintings have aged a little bit more. People in Japan are even older than they were when he first said it. And probably the walls are a little bit higher around China as well. So everything about the United States is in some respects less attractive than it was 5 years ago. Some of those are probably more of a trend break, going from an extremely low chance of the Fed losing its independence to something more of a meaningful fat tail risk. But the trends, at least in other places, which are the competitors and the comparisons, are in the wrong direction too. I think it'll be very interesting to see how Europe handles the challenge that's been posed by the United States, both through NATO and our engagement around the world, through tariffs and the like. The hopeful scenarios that Europe uses this as an excuse to sort of get its act together, can't count on the United States, can't blame the United States. I mean, it can blame the United States all it wants, but blaming the United States won't fix any of its own problems. What will is investing more in productivity, more in defense, and the like. So many people say the right things about all of that in Europe that I'm encouraged, except when I remember that they were all saying those same things like a decade ago and they still haven't happened.
Do you want to comment on this?
So, some years ago, I also wrote, why is the euro punching below its weight? With and one of the key arguments that we made had to do with the reverse of what I had said about the treasury. Namely, the euro is a single currency, but you don't have a single unified liquid bond market. Before the global financial crisis, right? The idea that maybe German bonds were somewhat close substitutes to other member countries was okay. After the global financial crisis, it was very clear that you had a very heterogeneous pool of individual debt markets. So how could the euro compete with the dollar? Well, I think it would take Germany issuing more debt, which it will be doing, and the Europeans moving towards a unified debt market, which has been on the table forever, but so far with little traction. But let me say something about the renminbi, because I think Larry is absolutely right in your quote, and I'll add one quote from Rudy Dornbush, which I love. He always said, "You never go to a party unless you know you can leave whenever you want to." And he was referring to capital controls. The idea of a reserve currency without convertibility, that you can't sell it. You can buy it, but you can't sell it when you need to, is a real impediment. Now, what could the U.S. do wrong to really catapult other alternatives? And there is the biggest no-no: capital controls. Now, I don't say this lightly, because no one, capital controls are, been seen as taboo in the context of the United States and financial markets for decades. However, I didn't envision 19th century tariffs either. So, I don't attach a high probability because that would be a driver of a meltdown in financial markets. But, I think the more realistic scenario is, the alternatives, gold only can take you so far, and diversification can only take you so far.
So before we open up the floor for questions from the audience, I would like to ask you a final question, and maybe you already answered actually in a way. 25 years from now, in 2050, how do you think the international monetary system will look like? Are we moving towards a more multipolar international monetary system, or do you still think the dollar will remain the anchor? It's a difficult question.
I mean, one thing we haven't talked about is whether stable coins or the version of them issued by central banks become a bigger thing. And if it is that sort of trivial that it's just in the plumbing behind the scenes, the way things are moving? Or are there, alternative currencies either linked to the dollar, not linked to the dollar? By the way, dollar dominance of stable coin is much, 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 much more overwhelming than its dominance of anything else, like reserve settlements, etc. But so that's one big question mark I have. I tend to think there'll just be a sort of back office thing that people won't be talking about them, but when you press your Venmo thing, it'll be something else rather than what it is now, but you won't really know the difference. But it's possible that could lead to something global, something decentralized, something that actually enhances the dominance of the United States because of this enormous first mover advantage that we have. I think it's like 1% of them are in Europe. You would probably know. So that's one thing we haven't talked about for 25 years from now. Second thing, though, that it seems extremely likely the world is multipolar, and that there's a set of economic considerations, but there's also a set of national security considerations. And for a lot of countries around the world, the ability of the United States to use the dollar to get information about them, to stop them from doing things like that, is undesirable. It takes time to build something up. I think China is a much more costly system to use and risky and uncertain than the dollar for all the reasons Carmen says. But if you're the sort of country that might want to invade your neighbor, it's sort of costly and risky to be in dollars too. And so that evolution that we've already seen on the multipolarity, I do think that at least on a 25-year time horizon.
Do you agree, Carmen, with this?
Yes, I do think that, financial instruments that we're seeing, the stable coins, are facilitating actually very, useful transactions. They're a vehicle for remittances. They're a vehicle for capital flight. Is this how people are successfully getting money out? But it's still dollar dominated. And one thing that I would add on the forward looking dimension is that the real possibility, in my view, it's the very high probability, is that while the dollar will remain, and this is my assessment, a dominant currency or the dominant currency, there'll be a tendency towards more inward looking. What do I mean by that? If you look at the era of globalization, it has cycled through history. We had periods of very big global integration in the early 19th century, before World War I. The two world wars basically hit the global financial system, the global trading system, and it took a long time to rebuild. I'm not being melodramatic. I'm not. But after the long period of trade and financial integration going hand in hand, we've seen a reversal. And of course, the Liberation Day was the most dramatic of these, but it wasn't the first. Since the global financial crises, we've seen a reduction in global trade volumes. We also had Brexit. We also had the first Trump-China war earlier, and it wasn't reversed. And now, of course, what I am saying is that I think we are seeing a period of greater fragmentation. But again, we go back to, the replacement isn't ready.
Yeah, there is some inertia. So maybe we can start with the Q&A. I don't know if you, John, want to start, break the ice.
So I want to connect a couple dots that you may tell me they're not connectable, and that would be fine. You
Get
talked
like
about
conspiracy theory.
not quite there, but you both talked at the start about the effect of confidence in the country and the increasing risk and how that may affect the perception of the dollar, the value of the dollar. And you talked about tariffs as one major contributor. One thing you didn't talk about, and it may be orthogonal, is some of the actions that shift the U.S. economy, in my view, maybe significantly towards a deal-driven economy as opposed to a market-based economy. Right. So when the government is taking 9.9% stake in Intel, when the government is taking 15% of NVIDIA and AMD's revenue on any sales to China, you're no longer looking at a market-based, competitive-based system where people are operating on similar standards. How much, if at all, do you think that's driving perceptions of the U.S., confidence in the U.S., and is it something we should be worried about in terms of its effect on the dollar?
So anytime anyone knows something really well, they tend to be more worked up about it. And sometimes that's because they know it really well, and sometimes that's because it's like their thing. So when, Trump replaced the head of the BLS or fired and is trying to replace, that's like a collection of economic data, something I know really well. I confidently predicted, we'd have a second Great Depression within a week because how horrible is it to have done that? And we still seem to be fine. I didn't actually do that, but I was running around hair on fire. You know about this much more than I do. But I think in this case, it probably is a bad thing. It's a mistake. But if I were to ask what I've learned about US productivity growth over the last year or two, I think I've learned far, far more positive news about AI than I've learned negative news about the stuff this will do to our country. And so it's probably sort of a rounding error on the negative side that is very well worth worrying about, but probably not something I would buy and sell dollars based on or dollar-based assets.
Do you want to?
Oh, it's not connected. I got it.
Any question? Okay. Carlo, there.
Thank you very much. My name is Carlo. I'm an MPP 2-year Italian.
This is like rigged.
Sorry?
Totally rigged.
Yeah, we know each other. My question is the following. For a long time, the dominance of the dollar was held also because of the oil payments that are usually settled in dollars. At the moment in Middle East, there is a growing, let's say, not confidence towards the United States with Qatar, UAE, and Saudi Arabia that are looking more and more to China. Do you think that the decarbonization and the problem in Middle East can hinder the dominance of the US dollar?
So I've actually worked in the last few years a great deal on the role of China in global financial markets. China's global footprint has increased dramatically. As an official lender, it is bigger than the Paris Club creditors combined, all the other creditors combined. It's as big as the World Bank. Most of its lending is denominated in dollars. So if Senegal takes a loan from China, it's over 75% of those transactions, that lending, is dollar denominated. So Senegal has to repay China in dollars. So you're really bundling two questions. One is the importance of China, the footprint of China. The answer to my gut answer to your question is yes. It will pivot many countries more towards China. Is that necessarily going to translate to a hit on the dollar? It hasn't. And, you know, I've tracked Chinese lending since it took off in the early 2000s. And you know, its footprint is global. I mean, it's not just, you know, sub-Saharan Africa, you know, parts of Latin America, Asia, and the mode of transaction involved.
Do you want to react? Other question from the audience? Okay, maybe we can take a couple together.
Okay, thank you. As Carmen and Jason just pointed out, rightly, that exchange rates are not predictable. And just as the seminal paper by Ken Rogoff 4 decades ago showed. But my question to you is that, how about gold? Are gold prices could be predicted? What might be the driving forces? Because gold has risen for over the past 3 consecutive years. So what might be the future of the gold prices? Thank you.
And maybe yeah. Then
hi, Moritz. I'm from MPP student from Berlin. As a note, as someone who has an income in euro and has to pay tuition fees in dollars, there's a shared maybe a tear of joy and a worry about the dollar developments. My question would be to euro bonds, as you mentioned, as Europe is kind of focusing more and is under more pressure. Could you make the case for maybe why now the barriers that have been in place for a long time, basically preventing an agreement on euro bonds, might be overcome? Thank you.
Okay, thanks. Who wants to start? Gold?
Or I can start quickly. I mean, the same efficient markets logic that applies to every other asset applies to gold, which is if you knew it was going up tomorrow, you'd buy it today, and then it would go up today, and that means it already has built into it whatever it is. Gold is also really does trade largely on, is like Bitcoin, and that it trades largely on psychology. There's, you know, some use dividend of it, but that is a trivial part of the price, as opposed to any company where there's earnings and there's how you discount those earnings, and maybe you can't predict that, but so it's, I think, unusually psychological. What you can do, though, is make contingent forecasts. Like if this goes up, then that's going to go down. And that was what Carmen was saying. If risk goes up, here's a whole set of things you think might happen. And one of them is gold goes up, maybe while something else like bond prices go down. And so you can hedge in that type of a way.
I'd like to add something to that, which is, you know, I'm not going to predict gold prices, okay? But, let's get that out of the way. But the central banks historically were big holders of gold. In effect, you know, I mean, I'm not talking about the gold standard. I'm not even talking about, you know, the Bretton Woods system. Even more recently, you know, and the pendulum swung and swung, so that many central banks really, you know, worked down their gold holdings. I think the pendulum may be swinging back. Of course, the more extreme cases are, you know, Russia and also China in terms of pivoting their allocation towards gold. But I think that may be a factor. But I'll second what Jason said, that it's really a big barometer of uncertainty. And I think, you know, just recently I was asked, well, is it all about inflation? You know, and of course, gold prices soared during the inflationary 70s. But it's not just all about inflation, because the relative price of gold also soared during the Great Depression, which had massive inflation. But it was the uncertainty, that era is also noted for international fragmentation. But I hope I didn't answer that question. To yours on the look, on what could be a driver for the creation and growth of a European bond market, I think one area where there seems to be some possibilities is the issue of defense, which cuts across boundaries, and Europe has found itself in a position where it has to rethink, defense in a way it had not in decades. And so possibly, this is really speculative, right? But you have to look for something that would be a common rather than a country-specific need to fulfill that role, which is why it's been so difficult.
Yeah, and if I may, personally, I don't see the political will to go in that direction, because even when it comes to defense, at the end of the day, we had the opportunity to have a pure European approach to that, but what we are seeing is that each nation is going its own way. So that makes me quite skeptical about this development, even if for sure this is the right moment to go in that direction.
Right. That's very much in the category of things everyone's known for such a long time that you get nervous why it hasn't happened.
So, other question? Over there, these two.
Thank you all for hosting this. I wanted to ask, you hear some talk nowadays about whether or not the exorbitant privilege of the dollar really is that much of a privilege, and kind of some pushback to the idea that dollar dominance benefits the U.S. And I think you've talked about how the causes of the erosion or the collapse of dollar dominance would probably be bad things, but talking about the consequences of the loss of dominance itself, what impacts you think that would have kind of domestically or more broadly?
Thanks. And we have another question over here.
Hi, I'm Fateh. I'm an MPID student, and I'm working on like how can central banks manage like their international reserves better in this time of transition that you guys have referred to. So Emmanuel Furhi wrote about the fact that we have different reserve systems and all of them are inherently unstable. So a unipolar one is unstable because of the Triffin dilemma. A multi-reserve system is unstable because we've seen in the interwar years, there was the Norsky instability. Because of that, like different actors try to rebalance their portfolios. So in that context, like what do you see the future of the international monetary system as, given the inherent instability in different models, and how can different actors like adjust their actions to better adjust through this transition period? For example, central banks, how do they choose their reserve currency allocations?
Carmen, you want to start?
So let me start on the exorbitant privilege question, and is it all bad if there's jitters and about the prospects of the dollar losing? Okay, one byproduct of dollar dominance has been, why worry about current account deficits? Why worry about debt? The rest of the world will always be willing to finance. And, I may shock some of you, but I am someone who worries about debt. And so I do think that, translated through what you were saying, a steeper yield curve, or making the debt costlier, may be a trigger factor to the U.S. finally thinking about debt sustainability in a more structured way than we have seen in the past. I think it was President Clinton, the last president, that really had, a view on U.S. indebtedness. On the issue of reserve management at times of uncertainty, I alluded very seriously. I alluded to the pendulum swinging more towards gold, but also I think while there is no other replacement full replacement for dollars. Certainly more diversification is you know a way to reduce dollar dependence. Another way, of course, is coordination between of reserve management and debt management. Countries that issue debt in dollars, which is a lot of the emerging world, will need dollars to repay them. So one way to reduce dollar dependence in an actually healthy way is to move more towards domestic currency debt.
So yeah, I agree with that second answer. On the first, I mean, exorbitant privilege is a useful way to think about it because it reminds us that this isn't a dichotomy that you either have or you don't have, but it's a continuum. And how much of it do you have? Similarly, when the pound gave rise to the dollar, it wasn't like the pound was at 100%, the dollar was 0, and then the next day it had reversed. It was a gradual process down for the pound, a gradual process up for the dollar. One of the benefits of the role the dollar has is that we can borrow more cheaply in normal times for a given level of debt and deficit. So the United States has the largest deficit of any of the advanced economies right now, and it has a pretty high debt combined with it. And by the way, maybe that's a disadvantage if it's a moral hazard that tempts you into doing that. People who do sort of very careful estimates of how much of a borrowing privilege we get, convenience yield instead of broader things, a lot of them are sort of increasingly of the view that it used to be maybe 50 basis points, maybe 100 basis points, and now it's 0 and might even be negative. So there's a chance that we've lost one of the benefits of that. Now, I said borrowing in normal times. There's another benefit, which is if everything sort of goes to hell, do you have some ability to borrow? And that's basically like insurance. And the United States probably still has that. The last time we sort of indisputably blew up the global financial system, it made people want to come to the United States more, not less, because they were really nervous. And where do you go when you're nervous? You go to the United States. This is in the financial crisis. So I think it still probably has that benefit. It is interesting to me that you've heard an argument out of this administration and Steve Mirren, who was or still acting CEA chair, and he's still on leave CEA chair, but a Fed governor, has argued that this exorbitant privilege stuff has hurt the United States, not helped the United States, that we're somehow paying a price to help the rest of the world. That's not a view I think that the majority of economists would subscribe to. But it's an increasingly popular view on a certain part of the far left that's hostile to globalization and far right in a horseshoe type way. And the argument has tended to be that because of it, we have a stronger dollar. Because we have a stronger dollar, we have less exports. Because of that, we have less manufacturing, and that's hurt blue collar workers. I would just note that insofar as we have a structurally stronger dollar because of all of this, that means that the 150 million American households that buy anything that might be made abroad can buy it more cheaply, and that outweighs any of the other considerations, not even talking about interest rates. So I think it's an important fact about the world that there are people who openly say that this is a bad thing, not a good thing. It doesn't make it right, but it might have consequences that people think that mistaken thing.
So probably we have time for one more question, if there is, from the audience. There isn't? Okay. Over there.
Yeah, I'm just curious of what do you think the potential impact could be of the H-1B visas fees on the market and on the exchange rates, because I think it may have a big impact on productivity in the US. Therefore, I wonder, what do you think how would it affect the exchange rate?
So I didn't check markets today, but there are companies that disproportionately rely on them and don't rely on them. So if there were some market moves in sort of this industry up, this industry down type of way, that wouldn't surprise me. There's a lot of legal uncertainty about it. There's a lot of uncertainty about what they're actually doing. They gave a lot of different explanations, whether they have the authority to do it. I certainly think if it stands, it will mean slower growth and slower productivity growth. But my guess is people in foreign exchange markets were not making particularly big or important bets on it today because they think that this one might actually be transitory, or insofar as it's not, it's part of the general increase in noise they'd already been aware of and they've already been aware of and factored in. So I think it is probably more sectoral. But again, if it stands in its form and it gets extended, I absolutely agree with you.
Do you want to elaborate on this? Okay. So thanks a lot. I think we can close it here. Thanks, Jason and Carmen, for your insight, and thank you everyone for showing up. And enjoy the rest of the day. Bye.